All right, like I said, this is going to be recorded, you guys. One thing I say at the beginning of all of these webinars is as soon as you guys get this webinar in your email, watch it again because it really makes things sink in. If you wait a week or a month down the road and decide, hey, you know what, I want to kind of refresh my memory on this earnings trade webinar, you know, a lot of this stuff has already been forgotten. And the best way to remember something is to review it very soon after you have gone over it the first time. It really makes it sink in. So I would highly suggest anybody out there, especially newer traders, to re-watch these over at least once more just to make it sink in so it will solidify in your memory. And this is going to be a great option strategies to take advantage of earnings. And this is a 4-part series on these different earnings type trades or binary event trades where you know, you're in and out really quickly. And these are going to end up being combined in the end, and we're going to take the call webinar and the put webinar and combine that in and create like iron condors and strangles. So it is really good to watch all of these because in the iron condor one, we won't go into the details on the calls and the puts for that matter. Anyway, my name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. I've been trading my own money for over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I'm here to help you take control of your finances, manage your own portfolio, and most importantly, manage your own risk. I say this because, you know, if you've looked at your latest funds that maybe a financial advisor has gotten you into, you know, the fees in those no-load mutual funds have a lot of embedded fees actually in there. You know, there's soft dollar arrangements and stuff like that where a guy's paying a broker money to facilitate these. In a sense, a soft dollar would be giving him a Bloomberg terminal or something along those lines. So there's a lot of money that goes out. And I've even read an article where it's almost like 40% of your overall notional value of your portfolio ends up over the course of your life being paid out to these different soft dollar and no load fees that are really fees embedded in there. So take advantage of it. I mean, even if you're losing a little money here and there on the learning process, you're still probably not going to lose as much money as you are through these fees that different firms are charging you. Anyway, I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products and in all market conditions. Some of you may be feeling like this in the last couple of days with the market coming off, and there's a lot of mutual fund investors that are feeling that way when they see their statements lately, because these guys have been getting beat up lately. This is a disclaimer I have to go over. It's just saying that any opinions, news, research, and analysis or information provided in these videos is not considered anything else other than general commentary. Cannot constitute investment advice. The reason why is because I don't know what you guys have in your portfolios. I don't know your risk parameters. So therefore, I can't possibly give you a strategy or security that I think would be good for your investment purposes, because I just don't know what you already have. I don't know what's in your portfolio. And at the end of the day, you guys need to end up doing your own homework. And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. Now that we have that cleared up, anyway, this is earnings trade setups, and like I said, we've done the calls. Now we're going to be getting into the puts, and these are great strategies for these binary events. As a matter of fact, I was kind of laughing it off with one of my friends earlier today, and I was almost batting 1,000 until today, and my computer froze up on the morning for trying to get out of my Cisco trade, and it didn't work out very well for me. But these are great. I love doing the earnings trades. I love it when earnings season comes around. It's just a great way to get involved. And what we're going to do is we're going to take advantage of this volatility collapse that happens in these different underlyings. The options really get pumped up with volatility going into these binary events, and afterwards you have this volatility collapse. It's probably 90+% of the time. Rarely will you ever see volatility expand after the binary event, because it's the unknown going into it, and as soon as the known is out there, that volatility collapses. And on the floor we called it the volatility crush. Everybody looked forward to that volatility crush after the big spikes. And we're going to take advantage of some theta contraction. And theta contraction happens as you get closer to expiration. It starts really getting steep. As you can tell in this chart here, we're going to be playing with the weeklies, and in this segment we're going to actually be able to go into the monthlies because there is only 7 days. But as you can see, this theta contraction really happens. Now, if you've watched some of the other webinars that we've done where I'm doing longer term strategies, I like to get in around this 40 to 35 day area and take advantage of this and then be out, just because there's a lot of gamma risk that goes involved in these. But with this strategy, we're going to try and take advantage of this really quick acceleration in the theta decay, and we're only going to be in it for less than 24 hours for all intents and purposes. You're probably going to be in these trades for 12 hours, if at all possible. Other than when your computer crashes like mine did for me today. This is going to be a bullish type strategy. So we're going to be looking for stocks that may have sold off. I was looking at Cisco as a bullish strategy today, and we're going to be looking at some other ones that have gotten beat up. Next week we're having a lot of retailers come out with earnings, so a lot of those have gotten beat up just because of Walmart coming out and putting a warning out there. So we're going to try and take advantage of some of that already sold off market and get in there. I'm more of a contrarian type trader. I like to get in the water when I see blood in the water. So keep that in mind also. It depends on your trading strategy. If you like to buy it when it's in a rally mode or something like that, that's when you would implement this type of strategy. I'm more, like I said, a contrarian, and when I see blood in the water, that's when everybody else is panicking, and that's when I like to get in there. So we're going to be trying to sell naked puts, or if you're like in an IRA or something like that, you might need to put on a put spread, or if your risk parameters are not quite as, I'm a big risk taker, so if you don't have a big stomach for risk, then you might be wanting to put on spreads. And we'll go into all that, how you can do those different things. If you're like to take the risk of like a naked put, but you're in an IRA, I'll show you ways that you can implement this type of strategy to synthetically mirror a naked put. Like I said, this is bull puts. We're going to be looking at selling premium. If you guys watched any of my webinars, you guys know that I like to sell premium. I like to be the house in a sense. I don't like to be the one sitting at the table and betting. I like to have the house odds, which we'll go into that. When you are selling premium, you are the house odds. And we're always going to try and receive a premium, especially in these binary events, because like I said, that volatility is really pumped up, and when that volatility comes out of those premiums, you can be directionally right if you're a buyer of those option strategies, but you're still going to lose money because there's so much vega coming out of those overnight that you're just going to lose money even if you are directionally right. So we are in the beauty of this is I can be directionally wrong and still have that premium come down so much that I could be in the money and still make money. which is a hard concept to look at. But if you watched any of these daily market commentaries that I've done, I've had a couple of them where I went into the money and was still able to cover my strategy for a profit, despite the fact that the volatility had come, or despite the fact that I was directionally wrong, I should say. And I will go into the platform a little bit later and show you how to visually see how you can be in the money and still make money. Hello, Andreas. Hello, Judith. Hi, you guys. Everybody's giving me shout outs. I'll shout out back. Moving on. So this, I've gone through this, and on Fridays, it's really hard to find the market maker move on some of these. And this is where you find the market maker move, right up here. And if you can't find the market maker move up here like you would on a Friday, then I will show you. This is Disney. This is an old snapshot of it, but I didn't have the opportunity to find a good one that had the market maker move. But for these earnings trades, this is where you're going to look to find that market maker move if you're on TOS. Most other platforms will have something along those lines too. So just keep that in mind. You can do that, or one of the other ways to do it to find the market maker move calculation is you take the at the money straddle, or the one that is closest to at the money, and multiply that by 0.85. Now, because I'm not having the luxury of having this market maker move on many of the stocks that we're going to be looking at, we're going to have to calculate that out ourselves. And it is a ballpark, as the market maker move is a ballpark on the platform here. It isn't 100%. It's not a guarantee. It is an estimation of all of the traders out there and how that volatility has affected those premiums, how that comes up. So, you know, if it was exact, we would all be millionaires because we'd be able to play it every time. So it's not exact. It is generally overstated, but there are times where it can outpace that market maker move. So what we're going to look at is the standard deviation. So this is a standard deviation bell curve for all intended purposes. So think of the puts being on this side and the calls being on this side. As the market goes up, you know, you would move up one standard deviation or down one standard deviation. If you've watched some of my other webinars on the regular strategies, then you know I like to kind of play around with this one standard deviation move. But with these strategies, I like to kind of split the hairs right here and go at the 1.5 standard deviation move, because that is a very rare occurrence. If you add up all of these, you would find that 84% of the time the market will land somewhere in this area, and only about what is that, 16% of the time up here. But when we're going to be looking at these, for the most part on the naked strategies, I'm going to be looking at 1.5 standard deviation, which is going to be right around here, and that's about a 10 delta. So we're going to be kind of looking at doing the 10 delta strategies for the naked ones. And if we can't get that naked strategy, or you have a little bit less risk, or you're a little bit more risk adverse, I should say, then you're going to probably need to move it in a little bit and then create a defined risk strategy. And I will go into all that too. I'm trying to move along pretty quickly here just because we do have a lot to go over. All right, so oh, I missed it. I missed one of these. But anyway, so some of the essentials for success on this is going to be picking the right strike, which I kind of went over there. My standard deviations were a little ahead of myself, but that would be picking the right strike, figuring out those standard deviation, and picking the right duration, which we went over. The right duration is going to be closer to along the lines of the weeklies, or something that's very close to the closest options series to expiration is what I mean. Joe's asking, don't you mean to have a 5 delta on each side? I'm looking at the 10 delta on the put side, or the like on the calls, the 10 delta on the call side. All right, so let's look at this. So and back to, I guess I put that slide in there. So the right duration. So that's what I was talking about. We want to be in this where we get the accelerated theta decay. All right, so, and picking the right environment. What I mean by picking the right environment, I kind of went over that. I want high implied volatility percent, and I will go into looking what that is. High implied volatility percent in this is going to be somewhere above 50% on this. I'll show you guys how to figure out the math on that yourselves, and I'll show you how to find that on the options grid when we go. But we want something well above 50, and usually when you're going into these binary events, especially when you're putting these strategies on the night before or the day before, if it comes out in the evening or if it comes out in the morning before the open, I put these strategies on basically in the afternoon or very close to the end of the day. The reason why I do that is because I want a clean number to figure out where that market maker move is, and when I get that market maker move, I don't want it to change throughout the days. You know, the market can continue to rally into that event and or sell off, and if I put that strategy on early in the morning, you know, that's really going to throw off my probabilities of success on this. So I'd like to put these strategies in the afternoon, as close to the close as I can. But the main objective there with the environment is having high implied volatility. You never want to sell premium in an environment where you have something below 50 for sure, especially on a binary event. And picking the right underlying. What is picking the right underlying? It means like picking something that everybody is involved in. You got a lot of players in there. There's a tight bid ask. If you pick something that not very many people trade, say for instance like roundies or something like that, I can't think of something right offhand, but if there's not a lot of players involved in there, then you're going to have a wide bid ask spread, and to get in and out of those, it's going to be a lot more difficult. So you want to pick something where there's a lot of people trading and there's a lot of players involved. I'm just going to quickly go over the max profit on these for the spreads. The max profit on the puts is pretty easy. It's going to be the premium you received. This is going to be where you have the short put minus the long put. Okay, you know, and you also have to take into account your commissions. Everybody's commissions is a little bit different, but you're taking the short put minus the long put, and that's your max profit. Your max loss, though, is going to occur when the underlying is trading below your long put at expiration. All right, and that is the difference between the strike prices and the credit received. So if you have a dollar wide strike price and you got 25 cents, you know, your max loss is going to be 75 cents. Does that make sense? I got a couple questions popping up. I'll try and get to them when we get moving. I'm just trying to hustle through this real quick. And your break even is your short strike price minus the net credit received. Okay, so if you sold a 50 strike and you collected 30 cents, then you know your break even is going to be when it goes $50 and what I say 30 cents, something like that. So if it goes above that, then or sorry, below that, because we're short. So sorry, 50 strike, 30 cents, so 49.70. Does that make sense to everybody? Those are pretty basic there. All right, so now that I blew through those, I hope I didn't lose anybody real quickly on those. Let's see if I can get my screen up over here. Now, George is asking, why do I watch the 10 delta for the naked strategies? I like to watch the 10 delta for the naked strategies because that gives me right around the 1.5 standard deviation move. Okay, so that's a pretty rare occurrence, and it gives me about a 90% probability of success. So a way to look at the deltas as opposed to your probability of success. If you subtract, it's the inverse. So if you have a 33 delta, your probability of success is going to be around 67%. Okay, so if I have a 10 delta, that means my probability of success is going to be about 90%. Does that make sense, George? My probability of success being my probability of being in the money. It's about a 10% chance of being in the money and a 90% chance of being out of the money. It's a little quick reference, so you don't always have to go up there and check it. It's a ballpark of right around. That's the way we looked at it on the floor. So that's why I like looking at the 10 delta. And I'll go, I don't know, I have CMG up here for some reason. But let's look at some different option or some different option chains that are going to have their underlyings come out on Tuesday. There's nothing really ever that comes out on Monday. I think we had Priceline come out on this past Monday, but I didn't see anything that came out this Monday. One thing that you can do to find out where all the earnings are is go into the Market Watch and go into the calendar, and I just checked off earnings. So as you can see here, none of these stocks, these are the ones that I'm talking about that there's almost nobody in there probably playing. I ran through them pretty quickly, but for the most part, there might be some in there that have a lot of players, but I didn't notice any that really would. But that's what I do. I go into here, click off everything except for earnings and find it. And then you can do this. It usually comes in pretty jumbled. So I click on this to get after before the market. I look for them. So on Tuesday before the market opens, we have Walmart. And so these are trades that you guys could put in on Monday afternoon, so that you would get this in the morning. And then Home Depot. So we got Walmart and Home Depot out on Tuesday, and then after the market, I don't think there's anything really significant after the market for the most part. And then on Wednesday before the market opens, there is Target in here. Target's in here before the market open. Target and LOW, which is like the Lowe's parent company, and GMCR is after the close, which is Green Mountain Coffee Roasters, or Keurig. Keurig's gotten beat up. I don't know if I would do this strategy with Keurig. It's a broken stock right now. But that's how I find out where my earnings are coming out for the most part. So let's go to and see for $600 stock. This is what I'm talking about for like a lot of players. A $600 stock and you only have 20-cent wide markets. That's pretty darn good. And this is after the market's closed, so a lot of bids and offers have dropped off the table, but it is a pretty tight market, generally speaking. So this is something that I would look for. So let's move on. Let's look at Walmart. What Andreas is asking, yes, I got an unpleasant surprise. Open Iron Condor, all legs in one trade. Got a credit, but my put leg went into the money. Closed them, but at the moment recognized that my bear call spread was open with a debit. I go in and CMG was what you were. When I do it, I on the monitor page, I just click on all of them, close the trade. I don't know what you did. Now, if one side went into the leg on your Iron Condor, what I would do, say for instance, it sounds like your calls went into the money. So when this happens, because your puts are basically going to be worthless when your calls go into the money on something like that, Andreas, then I roll my puts up and create an iron butterfly. So I end up having the at the money straddle on my shorts and then my defined risk on the other side. If you're doing it where there's almost no time left, then you got to roll that out in time. Like if you had that in November, you'd want to roll that out in time. Okay, so this is what I'm talking about. So here's where you can find the current IV percent. Now the IV percent is 99 for Walmart, as you can see here. And then if you look here, you can see I have the main thing I'm looking at always for any type of strategy. First thing I look at to decide whether or not I'm going to implement a strategy is the implied volatility. I really don't care what the market's been doing or any of that other stuff. The first thing I need to look at before I decide whether or not I'm going to sell this premium strategy is this implied volatility. Now, the way to figure out the implied volatility percent is to I'm going to close this down for a second just so I can write on here. And this is an equation that you guys can do and need to know. But where that implied volatility is now minus the implied volatility low. Okay, oops, the implied volatility low. I guess I ran out of room. It's not going to let me write over there. And then you divide that by the implied volatility high, okay, minus the implied volatility low. Okay, so where it is now minus the low, and then divide that by the high minus the low. Okay, so let's look at this screen again. And you know, right now it's trading at 30. And the reason why you need to do this for every single stock is because every single stock has you know, different volatility. So this is a measure of how the volatility has acted on itself. So as you can see, this is at the high for the most part. So you'd be able to just ballpark or look at this and say, okay, well, we're at 100% for the most part. Sometimes it's trading down a little bit lower. And right after the number, you're going to see this just crush. And so let me see if I can find, let's look at Priceline, because it just came out with earnings. And as you can see, this happened on Monday. See this crush? That's the volatility crush that happens. And you're going to see that after the binary event, you know, 90+% of the time. And that is where we are going to be able to make our money, because, for instance, in Walmart again, if we go to Walmart, what we can do is look at the layout here, and you go to theoretical mark and price. Okay, so you can play around with it by clicking right next to it. So if Walmart's coming out with earnings on the 17th, we can change this to the 18th, let's say. Change this to the 18th. And right now, well, you know what? I'm going to do this as if this just came out tomorrow, just so that it's a pretty clean thing. So today is Friday the 13th. All right, so Friday the 13th. So the next day, we have this event. So we put this trade on today. Tomorrow it happens. The market is trading right around $56.42. Let's just say we did the 10 delta or 9 delta, so $51. I probably wouldn't do that one because that's way too cheap. So in this regard, let's see if I can use this as an example. Let's figure out what the market maker move is first. Sorry, guys. So market maker move, we go to the straddle, figure out what the straddle is. It's trading, the at the money straddle is right here. So we pull up our calculator, and like I said, it will usually have it up here, but it's not going to help us because it's next week. So $2.15. So 2.15 times 0.85 equals $1.82. So I always round it up, never round down. So we're looking at the 54.5 area if we're just going to do the market maker move. So 54.5 area, and go to the, oops, that's why I didn't want that. I want single, and I want theoretical. So we're looking at the 54.5 strike right here. Okay, so it's trading right around 42 cents. Now, we put this trade on going into the end of the day, so we're probably getting 42 cents. And all of a sudden, the market goes down by $2. So we adjust our price by $2. So our theoretical price is going to be $54, and we're going to be in the money because we're doing the 4.5 strike. So we're actually going to be in the money by about 8 cents. But you know, as I talked about, volatility crush happens rather quickly. So if it goes down by, say, 30%, we get that. You can see it goes down by $2. Our theoretical price will end up being 19 cents. So we're in the money, but we're still going to be making 30 some odd cents because of this volatility crush. And we can even look at it like, what if I was pretty wrong and, you know, went outside of that market maker move and I was out by $3? That's where you're going to probably end up starting to lose money because you're in the money after $3. But you can be wrong a little bit, or $2.50, let's say, and we get that volatility crush. It's going to be, you know, trading 54, you're 50 cents in the money, and you're pretty close. I mean, that's how you can be wrong. And you know, if it, you know, goes from 100 to 60, then you can see that you're even better off there. So you're going to lose a little bit of money there, but you're going to still be saved by it being $1 in the money at this point, and or 50 cents in the money, and you're only losing, you know, 15 cents. And that's if you're really wrong. That would be a move that happens very rarely because that's outside the market maker move. And I don't know the statistics on it, but it's somewhere around like 80% of the time the market stays within the market maker move, which is what I was talking about it being overstated. So this is where you could be directionally wrong, and like I said, if it goes the exact market maker move, then you're going to end up making some money on that, even though you're in the money for the most part. Does that make sense to everybody? Too small to see. Oh, these numbers are too small to see. I don't know how I would put it on a separate screen. Implied volatility low at what point? Mary's asking. Implied volatility is low. If you can see this side of my screen here, these are the stocks that have low implied volatility percent right here. And it's usually when the market is rallying. As the market rallies, the implied volatility usually starts compressing. As a matter of fact, earlier on in the week when the market was moving up, there was almost none. I mean, it was very little stocks to pick from. Now it looks like about half of my watch list is above 50% because we've had this pretty big sell-off the last couple of days in these markets. Oh, you mean Mary, you're having trouble seeing the formula on the, let's see, let's see. This is the formula you're having trouble seeing. Let's see if I can erase that, write it bigger. All right, so, okay, so what we do is we take where the implied volatility is trading right now. Get my pen again. So where the implied, why isn't it working? And let me pick a different screen, see if it'll work there. So here, so we take where the implied volatility is now, implied volatility now, minus the implied volatility low. Is this big enough, Mary? Oh, you're asking where here, and then the implied volatility, the high implied volatility mark minus the low. That was the high implied volatility. I wrote that wrong. So on the, this is where you can pull this up on the option grid, but where the high is showing 30. So you basically subtract 30 from the low mark, and I just draw a line here and see where it shows. So 30 minus 13, and then the high minus the low, 30 minus 13 again is 100%. So if it was somewhere around the 26, you would say 26 minus 13 gives you around 13, and then 13 divided by 27 would give you around, 50 something, right? Yes, sorry, yeah, off the IV graph right here. If you don't have that percent, you can figure it out that way. So you look at the IV graph, figure out this blue mark will show you the high, or where it's trading now, I should say. And then I just draw the line here, figure it out, okay, and then write out my equation that way. Sorry. Can you please write down the Walmart trade? Yeah, we can look at writing this down. So for our Walmart, we came up with the move as being about $2, right? So I would be looking at, because Walmart's not giving us a lot of money in here, I would be looking at trying to sell probably, 30 cents is kind of like where I like to go if I'm doing a naked strategy, 30 some odd cents. If I could go down here to the 53 and a halves and get closer to this offer, maybe work it a little while and get 30 cents, then I would definitely look at doing something like that. One of the other things that I was talking to you guys about, if you're in like an IRA and you want to create this synthetic type of strategy, because it won't let you do naked short puts for the most part, what I do is I would sell this one, and then I go down and find the first strike that I can pay a nickel for it, or maybe just under a nickel. So it'd be like the 49s. Of course, you're not going to get as much, and you haven't decreased your risk that much or anything else, but it is like the loophole that you can have a defined risk strategy on that. If I'm going to do a closer, you don't have a very strong appetite for risk, then I would look to collect no more than like 25 cents for this, being wrapped around the market maker move. And I did find one, and I can't remember which one it was, but one of these strategies I found that you could do it right around 50 cents. Target, like I said, is coming out on Wednesday, and I think it was Target that ended up giving me the 25 cents. So straddle, it's trading around 72, so it's trading, let's just say $4.65. That sound good for everybody? Is the mid-market. I guess I could just look at the mark. So $72 mark is 65. So $4.65, $4.65. And then we multiply that by our 0.85. And I get asked every time, why is it 0.85? Well, I've asked that for several years when I first started going on the floor, and one of the things is it's a given, they say. You know, at the end of the day, it has to do with a pretty big equation, and it's an average for the most part, but you know, it has to do with the square root of the number of days times a couple of other different things. So times 0.85, and it's about $4. So target has an expected move of around $4 for the market maker move. So then I would take that in mind, and it's trading around $72. For instance, $4 below that, we're looking at the 68 strike. So $1. So if I were to try and sell that one and then buy that, you know, you're getting close to 25 cents. So I would probably try and work that at 25 cents for a little while and try and get that quarter. You know, this is a couple of days before the binary event, so these premiums will probably continue to go up a little bit, and you might be able to easily get that 25 cents. Does that make sense? How did I get the $4.65? Andreas is asking. So you go to the straddle, $4, and the at the money straddle, so it's trading right around $72. So that's the closest to the at the money straddle. And I went mid-market between these. So $4.65 is pretty close to the mid-market on that. Don't ever try and hit the bid or lift the offer on anything, you guys. You guys should have like 3 or 4 cancel replace orders when you guys are entering any order on any type of strategy, no matter what. I mean, if you're buying a stock or anything, always enter it a little higher than mid-market and then work it down. If you don't get filled right away, work it down, and that way you will find the real bid ask, and it's a little bit of price discovery that way. So start a little higher and work your way down. Save yourself a couple pennies. Over the life of your trading career, that will save you a lot of money. So you always take the at the money or the closest to at the money straddle, multiply it by 0.85. That gives you your market maker move. And then once you know that, then I go back to the singles and move it back. So this was the example where you know, you're starting at exactly the market maker move. It's a little tighter. What were we doing? The 68, 67, and that was able to get you the quarter. And you're right around that 32 delta, which gives you about a 70 or 68% probability of being out of the money. So that's where you would do your defined risk strategy. And then if I was going to go naked, you know, sometimes what I do is take it and I double that market maker move of $4, go $8 on something like, you know, a Chipotle or something like that, or Priceline. You know, those are the ones I'm always going to double the market maker move, and maybe even 2.5 times the market maker move on something like Priceline. But if you go for $8, so you're looking at the $64 area, and that would be where I'm kind of looking to get my naked strategy, somewhere between double the market maker move or the 10 delta, depending on my feeling on that. What is the market maker move? George is asking. George, the market maker move is what the so, you know, if you look at the options grid, as you know, there's thousands and thousands of people in here and they're trying to determine price. So as you know, people buy up options, that price goes higher, and what it does is it gives you an indication as to what the overall sentiment is in the market as to what a huge what's the word I'm looking for, like a huge polling of what everybody that is trading this product thinks that that underlying could move on that binary event. Does that make sense? Also asking, you sell a naked put or a bull put spread, and that depends on my assumption. So if I'm pretty confident, like, and it also depends on how much I'm going to be able to collect for that strategy. I'm always looking to collect around 25, 30 cents, something like that. So that's if I can get a defined risk strategy, then that's what I'm going to do. If it's a real big mover, something like the Priceline, the Chipotles and stuff like that, that's always going to be, I shouldn't say always, but 75, 80% of the time, I'm going to be picking a defined risk strategy. And if I don't want to hold this portfolio, and you're selling a naked put, if you aren't comfortable holding that, then, or taking possession of that strategy or that underlying, then I would be picking a defined risk strategy there as well. So keep that in mind when you're doing these. If you're thinking, you know what, I want to be out, or I want to have a stop loss, then that's where I want to pick my defined risk strategy. That's the beauty of having options, you guys, is if you create a defined risk strategy, you have a built-in stop loss. If you put a stop in the market on an underlying and or a particular stock or future, you never know where that stop's going to get filled. And if you put a stop limit order, then you might never get filled. So there's a lot more risk there with a stop loss or a stop order. Whereas when you're doing option strategies, hey, you know exactly where you're out. It doesn't matter if the market gaps up or gaps down on you and goes through you. You're out. That is done. So that's what I love about options, is what you're getting into before you get into it, and there's no slippage on those stops. If I'm wanting to get out, I know exactly where I can get out. Does that make sense? What is the exact time to enter a trade? That's to each his own. If you're asking for an earnings trade, I look at the charts too. So I would look at like support and resistances. So this is, obviously target, but I rarely look at the 15-minute chart. But I would look for a bounce or something like that. But I don't really look at the chart. For options, it's I look at it, doing it at the end of the day, because that's going to give me the cleanest number. Okay. Is that it? George, did I answer your question on the market maker move? Anybody else have any questions or want me to? Yeah, George, so I'll go over the market maker move again. Basically, it is the straddle times 0.85. So you go to the straddle, pick the closest at the money straddle, and then multiply it times 0.85. So it's trading 72. So we look at this, mid price. I'm just going to go at the mark. It's, and it's a ballpark, you guys. So you just basically take the straddle, what the straddle is trading, and it's trading 463 now. So 4.63 times 0.85, it's always 0.85, and it gives you right around, and I always round up, $4. I'm never going to round down. I'm going to always pad that number, okay? So always pad it. Give yourself a little bit of extra. So $4 makes us look at this no tighter than the 68 strike. No tighter than the 68 strike. So the 68, if I'm going right at the market maker move, I'm usually going to have a defined risk strategy on, because you can usually get that 25 cents the width. But if I want to create more of a naked strategy, I'm going to look at the 10 delta to the double the market maker move, which would be about the 62 strike. So somewhere in there. And if I'm going to go in an IRA or something like that, I would probably look at this 10 delta and then buy the first contract that I can pay, a nickel for, which these are pretty, this 55 strike or something like that would probably be the place where I could get it for a nickel. And you can play around with that too. If you can't get the 55 strike for a nickel, and that's just my ballpark thinking on it. You can pay up to 6 8 cents, something like that. So play around with it. If you don't feel comfortable going another $5 for 3 cents, that doesn't make sense either, right? So I would rather pay, 3 or 4 more cents for this strike than having to go out another $5 and save myself 2 cents. Does that make sense? Because if it's going to blow through this 55, it's probably closer, going to go to that one as well. Do I predict which way the market will move? The market maker move is plus or minus whatever that is. So that straddle is, the market maker move is predicting it's going to go up or down $4. Okay. Do I predict? No. Well, actually, yes. I do a lot of times go into these events with an assumption. And, my assumption right now with Target and Walmart, I'm going to probably go into Walmart with the assumption that it is oversold because, what was it, their CEO or their CFO came out and blasted that they were going to miss, probably because anytime they say something like that, it's going to miss by more than 5%. So when that came out, now Walmart sold from that day, came off from 68 down to 56-ish. So that's close to a 20% move, isn't it? So to me, my thinking on this, I'm going to, obviously wait till Monday to look at it again. But my thinking on this one is it's 20% move. That's pretty oversold. There's, people bailed out way too early on that, I think. So I'm thinking this is going to be one to set up for a bull spread, because I think the pent up selling has happened and it's had a pretty massive down move. But again, having said that, on something like this where it's kind of become a hated stock, this would be one that I'd be looking at having a defined risk strategy on. So I would probably go closer on this one to the market maker move. And so that's $2, so $1.60, $1.70 I'm looking at. Is that $1.70 if I do the math? I'm just trying to do the math in my head right now, you guys. So forgive me for that. So it's $2.15. So the straddles are right around $2.15 times 0.85. $1.80, what did I say? So I round that up to $2. So we're looking at the 54.5 area. So, you're not going to get 25 cents for this one. Oh yeah. Wait, what did I, oh, thought that was a little strange. 16 cents. And so for $1 wide, that's not very good in my eyes. So I might have to look at this as maybe even a naked strategy or something. This is what I go through. 7 cents on the 10 delta is not enough money. Even, I mean, this might be one that I even pass on just because to get my 30 cents, on a hated stock, I don't know. Probably do the defined risk strategy on that Target one though. That one's set up pretty good. But this one, I might have to pass on this. This is too risky in my eyes. I mean, unless, you want to sell this and you're thinking, if I'd be happy to buy Walmart at $54 or, own that for my core portfolio. That's a different thing altogether. Hey, I can either collect the 40 cents or I can own Walmart at $54 and I'm comfortable having that in my core portfolio for a while. Then, that's a different situation also. You got to run through all of these things when you're doing these strategies, how you want to play it, $54 for Walmart, which seems to be taking over the world in regards to the retail, along with Target, now that they do groceries and everything else. I mean, I like Walmart, so but I would have to weigh that out. This just doesn't seem as tantalizing as going for Target. Plus Target, didn't come out and say anything, right? So Target got crushed because of what Walmart said and has been taking it on the chin, and they haven't said anything. So they could be doing just fine. So the real thing might be to just play the Target as being well oversold because of what Walmart said. And even like Home Depot, which comes out on Monday, we talked about. Home Depot's been getting beat up also. So Home Depot, and I do Fibonacci and stuff like that, you guys. Do I believe in this being something that is garnered by math or whatever? I just know that everybody's looking at these, so sometimes that makes it come to fruition, right? So I don't know if I believe in all the tea leaves and all the other things some other people say about how leaves have this in it and all that stuff. I don't know. But so we could look at Home Depot. Home Depot has the market maker move as 120. So this went right out at 120. So that makes it easy. So we're looking at $4.85 ish. So for the straddle, which is just the ballparking it, it's probably pretty close. I'm just doing both strikes, adding them in my head. But you can do the straddle, and the at the money is $4.85 is probably closer. So if we take the $4.85, 4.85 times our 0.85 gives us our market maker move of $4 and $4 plus. So I would go outside of $4, which would put me at the just below the 14. So I'd be looking at the 115 strike. And the 115 strike is going to give us, let's look at the deltas on it. It's probably closer to 30 delta, no, 23 delta. And it's going to be harder to get that quarter there. But so what did I say? $5 we're looking at. So $8 to go lower, we'd be looking at the 12 strike. So that's double the market maker move. It's the 10 delta. I might even look at doing that because I think that that they've gotten beat up along lines with everybody else. So that would be probably one where I would go and look at it as the market maker move is $4. I'm going to double that, $8, go into the 12 strike and get 50 cents for it. I'd be pretty happy with that. Plus it puts it below, you might even go a little bit lower and get below this Fibonacci level. So you can see that it's acted as support, and that's been right where it likes to trade around. So that might even be something I look at. Just taking that extra tick, rather than going to the 12, I might want to go down there and test the 111s. And that's about all I do with those Fibonacci levels. I don't swear by them, but I know that that is acting as support, and that's where it's had a tendency to trade in the past. So that might make me go to the 111s rather than the 112s, and I'm only losing out on maybe 10 cents or something like that. Does that make sense? I don't know why they're sometimes colored and sometimes red. I think it usually has to do with, are you asking about on the option grid why some of the bid asks are colored and some are not colored? Something I've never been asked before, but I think also some of these, I know that these are the different exchanges like the M, the A, the X, and stuff like that. So the idea behind the market maker move is if that is the median of what the overall market believes, and it's usually overstated, then that's why I like to go a little bit higher than that. I like to be in the it's kind of like the standard deviation, right? So I'd like to be able to be on the further end of the tail, so to speak. That's the idea behind the market maker move. It's just what the overall market is thinking the move is going to be. So if you go outside of that, you're becoming more of the house. If you're inside of that, you're kind of sitting at the table. You're playing blackjack and you're kind of doing that. Whereas if you're outside that market maker move, you're kind of acting as a house. You're increasing your probabilities of success and just kind of collecting a little bit of money here and there. Does that make sense? Yeah. So, you know, it comes from experience. Being on the floor, that's what we used to always do on the floor is we were always trying to figure out what the market maker move was for anything, you know, like with being Fed funds and being in the bond pit or in the bond room, you know, we were always working on probabilities, and I always tried to make sure that my probabilities were better than 50-50. When you're buying a stock, your probabilities of success are 50-50. So, because it could go up, it could go down, right? So I try and get the probabilities in my favor, and that's another reason why I love the options is you can play the probabilities. John's asking, how do I select the underlying? I look at things that a lot of people are trading, and a lot of these on my watch list were, you know, already in there. So I can't say that I've ever traded CON, and I don't even probably know what that is. But the one thing, I don't have to trade a stock that I know or anything like that. You know, I look at this bid ask, and for $100 stock, if it's inside at 10 cents, then that's something I'm going to trade. If it's something like rig, you know, I'm going to be looking at something that needs to be inside of a nickel because it's a lot less, you know, premium in there. So it's like what is rig these days? I don't trade rig a lot because it's hard to get outside there, and it's $14 now. So if you look at rig, you see it's a penny wide. So that's how I decide. If it's anything outside of a nickel, it better be something that's a high flyer like CMG. You know, that would be something where you're never going to get inside of 10 cents. But having said that, there's so many players in here. It's 20 cents wide for a $600 stock. That is pretty darn tight, you guys. And if I went in at 745 and at 730 bid, I bet you there's enough players in CMG that I would be able to get filled on. So I look for high volume and open interest. And if we look at volume and open interest on this, it's you know, they're probably settling down on these, but you can see there's a lot of volume going on in there. If you go out even in the monthlies, you know, there's even going to be more. So these are, you know, you can tell there's a lot of trading going on in CMG daily. So that's what I look for, volume and open interest. If there's a bunch of zero in here on the volume, then that's something that I'm probably going to stay away from, because to get in and out of that, you're going to have to be giving up a lot of edge. Does that make sense? When there's a lot of players in there, like in CMG, and I put it in at 745, the people in this market know that 745 probably isn't going to last very long, so they're willing to give it up. Whereas if you're in something where it's 20 cents wide and there's not a lot of volume and open interest in there, you could just let it sit, because everybody, the counterparty, is saying, you know, you're going to have to come to me. I know nobody else is going to buy it but me. I'm the only one been buying it all day, right? How and when is the settlement price calculated? Is that what your question is? There's so many determining factors in that. You know, if somebody wants to pay up to get out and things of that nature, but on a daily basis, there's an algorithm, and it has to do with like the amount of volume that traded at a particular price. I don't know how they do it on this, but I know on the floor it was the volume that traded, and then, you know, if the volume traded closer to the offer going into the close, there was a lot more volume there, then that one would take precedent over the bid. But generally speaking, it will be the bid ask, where the most volume traded, and then it will settle. If it was on an up day, it would settle closest to that settlement. So on an up day, it would settle slightly down, and on a down day, it would settle slightly up. For index, I don't know. Andreas, email me and we can talk about that in a little bit. All right, does that pretty much answer everybody's questions? So it's something like, you know, Target, I think, is probably a better alternative, Target and Home Depot, because I think they've been brought down by Walmart's comments, and I don't think that Walmart just has that that premium in there, despite the fact that Walmart's, you know, at a 99 IV%. So I'm going to be looking at doing, I'm glad this landed on this whole cycle, because I'm going to be doing some puts on these, because I think that this sector of the market's really been beat up and is a little bit overdone. All right. Last thing is, you know, I want to thank you guys all for doing this. We are doing a different premium package, 1 month trial. The last one's done, but for only $7, get a couple more people in there. You get the daily market commentary. You also get the options training videos, and you also get these live trading workshops. Now, my daily market commentaries I go over every single day, and during this options or earnings cycle, I've been talking about all of my earnings trades that I'm looking at and how I played them and why I played them that way. And then I also talk about the longer duration ones that I'm doing. And then the training videos are kind of like 15-minute quick snaps on what all of these strategies are about and how I go about implementing different types of trades. And then these live trading workshops. All right. So you guys can do these webinars. But later ones, we're going to be drilling down on different options trades and when and where they're appropriate. Like I said, next week, we're going to be doing it on the iron condor, where we're going to be combining these two and creating iron condors around these binary events, and strangles, which is the non-defined risk aspect of an iron condor for all intents and purposes. The web link is for this special offer is in the chat box, you guys, so you can click on that link and go to that offer. Also on Monday, I'm going to be a panelist on a trading online show, so if you guys want to check that out, it's on Monday. I think it's around 1 o'clock Eastern or something like that, but you can email us at ProTrader or email us at protraderstrategies.com. We can get you more information on that. The more the merrier. I've watched a couple of those, so you guys can check that out. That'd be fun. Or you can call us at 310-598-6677. All right. Thank you, guys. I appreciate your time here on a Friday. I'm sure everybody wants to get out of here after a long day of trading, but that's about all I got for you today. And if you can't take that, take it easy. Thank you, guys. Take care. Thanks, John. Well, have a nice weekend too, Andreas. Everybody have a nice weekend. Take care. Enjoy your Friday the 13th.